Welcome to Different Makes a Difference, where we discuss investment matters that matter to everyday investors. Join Odlum Brown's equity analysts as we examine pertinent topics in today's markets and look at things a little differently. Odlum Brown is an independent Canadian investment firm. We provide integrated wealth management solutions to help clients achieve their financial goals, and we've been doing so for over 100 years. Join us for some lessons we've learned along the way that can make a difference for the future.
Hello and welcome to Odlum Brown's Different Makes a Difference. I'm Stephen Boland. The world is full of complexity and uncertainties, and that applies to investing as well. Our guest today is going to argue that amidst this complexity, simplicity is the answer. Simple wins. Our guest is Odlum Brown's Chief Investment Officer, Murray Leith. Welcome back to the podcast, Murray.
Great to be here.
Murray, you've written recently about the power of simplicity in investing, and you began your piece by quoting none other than Forrest Gump. Why did you start there?
Well, it's because Forrest had a line that everybody knows. Life's like a box of chocolates, and you never know what you're going to get. It's a perfect metaphor for markets also. They're unpredictable and full of surprises. And Forrest kept things simple. He didn't overthink, and in many ways, that's the essence of successful investing. Keeping things simple, behaving well, and not getting distracted by the day-to-day noise of the markets or shiny new products.
What you're saying is that simplicity is actually a strength.
Absolutely. It fuels something that I call behavioural alpha. That's the extra return that investors earn, not by picking the perfect stock or timing the market, but by simply behaving well. It comes from staying invested, resisting panic, and not chasing fads. You and I well know that our industry focuses on performance alpha, beating the market, keeping up with the Joneses, and having bragging rights at cocktail parties. But most investors don't do well in that race, not because they're unintelligent, but because they're human. We're wired to seek safety when markets fall and excitement when they rise. And if you can avoid those mistakes, you have a powerful edge over the average investor. Simplicity is what makes behavioral alpha possible. When you keep things straightforward, people understand what they own. And that understanding builds confidence. And confidence helps them stay invested through the inevitable ups and downs.
Well, that's a great point. Can you give us some examples of complexity hurting behavior?
Sure. Let's think back to the late 90s during the dot-com bubble. Investors were told that the old rules didn't apply anymore. Analysts invented new metrics like price to clicks or price to eyeballs. If you had website traffic, never mind profits, it was worth billions. Complexity and jargon disguised the fact that most of those businesses had no real path to profitability. And of course, when the bubble burst, investors lost fortunes. Look back to the 2008 financial crisis. Structured mortgage products some of them were stamped AAA, supposedly as safe as government bonds. But the complexity of those structures hid the real risks. Most professionals and even the rating agencies didn't fully understand what was inside. And when housing prices fell, even the top-rated tranches got beaten up really badly. Investors who thought they owned the safest slice of the market discovered they owned something very fragile and dangerous.
So complexity can give people a false sense of security.
Yeah, and compare that to something simple like owning shares of Coca-Cola. If Coke's share price drops 25%, most investors can still picture someone drinking a Coke tomorrow. And that's an image that anchors them. It makes it easier to ride out the volatility.
Yeah, that's a great example. So simplicity actually becomes a behavioral cushion.
Yeah, it reduces the odds that you'll abandon your financial plan. And over the long run, that's what really matters the most.
So would you say that this clarity translates into returns?
Absolutely. The market can deliver great returns, but many investors don't actually earn them. They jump in and out at the wrong times, and simplicity reduces those mistakes.
We were chatting earlier today, and you shared an example with me about a fund that really illustrates this complexity trap.
Yeah, it's a real beauty. And I heard it on CNBC driving in this morning. Cardone Capital has a fund called 10X Miami River Bitcoin Fund. On the surface, it sounds cutting edge, apartments and Bitcoin in one neat package. Real estate, cash flow, feeding crypto exposure. Sounds smart, I guess, but it's just a marketing cocktail that adds a hot theme to a less popular strategy to make it sound cutting edge.
So it's a product that isn't designed to deliver superior returns, it's designed to sell.
Yeah, of course. And here's the irony. Investors think complexity will give them an edge, but it often just fattens the fee stream for the manager.
So that brings us to another point. You've said that investors today face more choice than ever. There's ETFs or exchange traded funds, hedge funds, private equity, private credit, crypto, thematic funds, the list goes on. Isn't more choice supposed to be a good thing?
In theory, yeah. Choice should empower investors, but in practice, it overwhelms them. Psychologists call it the paradox of choice. Having too many options doesn't lead to better decisions. It can lead to paralysis or poor decisions. Imagine walking into a grocery store. There's 2 kinds of jam. You pick one up, you're happy. But if there's 50 kinds of jam, you could get anxious. You second guess yourself. You might even walk out without buying one. It's the same thing with investing. The sheer abundance of options leads investors to hesitate, or worse, to chase whatever looks shiny in the moment. They buy what's hot and not what's sensible. And the financial industry knows this. They keep adding more products, more funds, more wrappers because novelty sells. If a product combines gold and copper or real estate and crypto or whatever 2 things are in the headlines, it attracts attention. But just because something's new doesn't make it good. And just because it sounds sophisticated doesn't mean it will produce better results.
Right. We confuse complexity with intelligence.
Yeah, we assume important problems require complicated solutions. In medicine, if you have a rare disease, you expect a complicated treatment. Investors think the same way. A portfolio of high-quality businesses, some conservative bonds, periodic rebalancing. It's not glamorous, but it works. It's understandable, and because it's understandable, it fosters good behavior.
So, Murray, let's shift to private assets. We hear a lot about private equity and private credit, private real estate. The story sounds great. Higher returns, diversification, smoother rides, unique opportunities. You wrote about this in Odlum Brown's September newsletter, which was titled Pitch Imperfect. Why are you skeptical?
Well, because the pitch rarely matches reality, and we can break it down piece by piece. Let's start with liquidity. By definition, private assets are illiquid. You can't sell an apartment building or a private loan the way you can sell shares of Apple. Yet many funds market themselves as having redemption windows where you can withdraw your money, quarterly, annually, sometimes even monthly. And it creates a bit of an illusion of liquidity. But when stress comes and too many people want their money back at the same time, redemptions get frozen. And they call that gating. We've already seen that happen in Canada. Private real estate funds and mortgage funds have gated redemptions recently, meaning investors can't get their money out. People who thought they could redeem on demand are finding out that they can't.
So it can be liquidity until you actually want it.
Yeah, the worst time to discover that you don't have liquidity is when you need it most. The second factor to look at is volatility. On paper, private assets look smooth. The statements don't bounce around like public equities. And that's because they're not priced daily. Sometimes they're priced only monthly or quarterly, and often based on appraisals or models. But that smoothness is artificial. Risks don't just disappear because they're not marked to market every day.
Right. Investors see a calm chart, a fairly stable price on paper, but the risk is still there.
It's just hidden. And when time comes to sell, especially in a downturn, you discover the real volatility. Third point that I wanted to touch on is diversification. The pitch is that private assets don't move in lockstep with public markets. And that's sometimes true in normal times, but in stress, correlations spike. Irrespective of whether stocks, credit funds, or real estate are public or private, everything that is tied to the economy and credit markets moves together. Think back to the financial crisis in 2008 or the pandemic in 2020. Private equity, private credit, real estate were all under pressure at the same time. It's like owning a boat, a kayak, and a paddleboard. They look different when the tide is high, but when the tide goes out, they all end up on the sand together.
So the diversification is overstated.
Very much so. And then there's the idea that these things are, quote, unique opportunities, which creates an attraction to something special. But the truth is, the best deals usually go to the big players. By the time they're packaged for retail investors, what's left is rarely that great. Then there's returns. Private equity looks brilliant historically, but context matters. From the early 80s to the early 2020s, interest rates fell steadily. Valuations expanded, and leverage was cheap and plentiful. That created a golden era for private assets. But those tailwinds are gone. Interest rates are higher, borrowing costs are real, competition is fierce. Frankly, we question whether an illiquidity premium exists at today's valuations. And the last thing to touch on is fees. The classic model is 2 and 20, meaning 2% management fees plus 20% of the profits. Add in transaction fees, deal costs, sometimes leverage charges, and the net returns can shrink quite a bit.
So when we add it all up, overstated liquidity, hidden volatility, questionable diversification, lower returns, and heavy fees, it can be less enticing than it originally sounds.
Because the pitch is polished and the products are positioned as exclusive, many investors find them irresistible. But, to be clear, we're not saying that there's no place for private assets. In the right situations for the right clients, they can play a role, but investors need to approach them with eyes wide open, not through the lens of the sales pitch. And the price has to be right. And I'm not sure that it's right today.
I remember a number of years ago when the movie The Big Short first came out. It was based on the book by Michael Lewis about the great financial crisis. And we all went to the theater together to watch. And you still talk about the story of Michael Burry. It's a perfect example of how liquidity can be a blessing and a curse.
Yeah, it's one of my favorites. Burry is an eccentric hedge fund manager who saw the housing collapse coming long before others. And he made billions for his investors by shorting mortgage securities before the financial crisis in 2008. But what the movie barely touched on is the fact that his clients were absolutely furious with him along the way. His trades weren't working for a long time, and the clients wanted out. They demanded their money back. And the only reason they ultimately made money was because Burry had a clause in his fund documents that allowed him to gate redemptions. In other words, he could lock the doors and refuse to let people take their money out.
So the very thing that angered his clients ended up saving them.
Right. They hated it at the time, but it protected them from themselves. Had they been able to redeem, they would have lost out on the very trade that later made them fortunes. And that's the paradox of illiquidity. Sometimes it's a feature because it prevents investors from making emotional mistakes. But if you don't know about it or you feel blindsided when the gates come down, it feels like betrayal. And that leads to anger, mistrust, and more bad behavior.
So illiquidity can either protect investors or backfire completely.
Yeah, the difference lies in expectations and communication. If you know and accept that your money is locked up, you can live with it. If you think you can get it out anytime and suddenly you can't, you feel trapped.
So I'd like to zoom out. You've said that just about everything looks expensive right now. Can you walk us through that?
Yeah, but it starts with the flood of money that's poured into the system since the global financial crisis and then the pandemic. Trillions of dollars of stimulus, near zero interest rates for years, quantitative easing, which is the government or the central bank buying bonds, direct government spending. That wave of liquidity had to go somewhere, and it went into assets, stocks, bonds, housing, gold, you name it, all got pushed higher.
Can you dig into each of those assets a little bit more?
Of course, but we'll start with stocks. Valuation multiples are high and earnings are also cyclically strong. Over the long term, stocks return about 10% annually, but over the last 5 years, returns have been closer to 15. That means mathematically, the next 5 years could be closer to 5% if we're going to get back to that 10% average. With bonds, credit spreads between high-yield bonds, corporate bonds, and government bonds are near record lows, which means investors are not being compensated much for taking extra risks. Housing, particularly here in Canada, is very stretched. Prices are high relative to income. Consumers are over-leveraged. A lot of mortgages are rolling over at higher interest rates, which will put pressure on households and house prices. And then there's gold, the price of which has doubled in short order, And it's actually outperformed the world-leading S&P 500 index over the last 20 years, which is actually quite incredible.
Yeah, it's a tough backdrop because diversification is hard when everything is expensive.
Exactly. You can't combine a basket of expensive things and expect to magically reduce risk.
And then there's the Magnificent Seven, the big tech names that have driven so much of the market's performance.
They certainly have. They're incredible business, and we own a few of them: Apple, Microsoft, Amazon, and Alphabet. And they've transformed industries and delivered fantastic returns. And they keep doing it. They keep growing faster than the rest. But they're massive, beloved, and they're not cheap. Their multiples are high, and those multiples are applied to margins that are already at cyclical peaks. It's a bit of double counting. Investors are assuming that growth continues and margins stay elevated. That's certainly possible, but perhaps not probable. And history provides some cautionary tales. Nortel here in Canada, Cisco in the United States. Both were world-class companies in their day. They seemed unstoppable, but when growth slowed, their valuations collapsed. Cisco stock, they're actually still world-class today, but their stock, for example, it's still below its 2000 peak 25 years later. And Nortel, of course, went bankrupt.
So today, we're saying you should participate, but with caution.
That's right. It's not about trying to call tops and bottoms. Nobody gets that consistently right. It's about sizing positions. That's how we handled the technology mania at the turn of the century. We certainly didn't call the exact top, but by keeping our exposure modest, we avoided the worst of the collapse. And we took the same approach during the commodity bull market in the 2000s. We owned resource stocks and benefited from the upswing, but we didn't bet the farm. That discipline meant that we preserved gains when the cycle turned. And it's no different with the Magnificent Seven today. We participate, but position size keeps us from being overexposed if and when things shift.
Yeah, when you add it all together, pricey stocks, expensive bonds, stretched housing, a run-up in gold, it's a tough environment to find bargains.
Which is why discipline, patience, and conservatism matter more than ever.
So, what do investors do with all of this? We've talked about behavioral alpha, the paradox of choice, the pitfalls of private assets, and the fact that everything is expensive. What's the practical solution?
The solution is to embrace simplicity as a discipline. Start with high-quality businesses you understand, companies with durable competitive advantages, strong balance sheets, and predictable cash flows. These are businesses you can hold through a storm. Second, recognize that price matters. Even the best businesses can be a poor investment if you overpay. So be discerning. If something's popular and pricey, don't chase it. Size positions accordingly. Own some, but don't let it dominate your portfolio. Third, use fixed income for balance. Bonds might not be exciting, but they provide ballast when equities are volatile. And in today's environment, we favor high-quality bonds, government or investment-grade corporates over high-yield bonds. Credit spreads are too tight to justify reaching. A fourth point is avoid leverage. Debt magnifies risk. In an environment where valuations are already risk, layering on personal or portfolio leverage is dangerous. And the last thing that I'd say is stick with the biggest and best capitalized banks, not the mid-market players, not the private lenders that are scrambling at the edges. If you're buying GICs, buy them from the strongest institutions. Safety and resilience matter more than squeezing out an extra 0.5% of yield.
It sounds pretty conservative.
It is, and that's the point. In a world where every asset class looks somewhat pricey, conservatism is a competitive advantage. It keeps you in the game. And above all, remember that simplicity fosters good behavior. Good behavior delivers behavioral alpha. And that, I think, is a true superpower.
And in practice, that means quality, discipline, and patience.
You got it. It's not about predicting what happens next quarter. It's about owning good businesses, avoiding panic, and letting compounding do its work.
So we've covered a lot of risk in this discussion. I know you always like to end on a silver lining. What's the bright side here?
The positive here is that tough markets remind investors to be disciplined, and that discipline sets up better outcomes down the road. Another silver lining is that crises force improvement. Canada, I think as everybody's well aware, has vulnerabilities, including housing, productivity, and debt. But adversity often pushes countries to reform. Politicians who would otherwise kick the can down the road are forced to act, businesses adapt, and individuals become more disciplined. On a personal level, investors who embrace simplicity put themselves in the best position to succeed. You don't need to predict the future perfectly. You need to own quality assets, avoid leverage, and stay invested. And here's the ultimate silver lining. Compounding never sleeps. If you own a business that earns solid returns on capital and you hold them through thick and thin, time is your ally. The future will always be uncertain, but discipline is timeless.
So even though the world feels riskier financially, economically, socially, geopolitically, the antidote is still the same. Keep it simple, be conservative, focus on quality, avoid leverage, and know what you own.
That's true. It's the best way to stay on plan and achieve your goals.
Well, Murray, that was great. A lot of really good information and great advice in that discussion. Thank you for joining us. Thanks to everyone for listening. Murray has written several pieces recently on this topic, and we'll post links in the show notes to those pieces so that you can read. Before we go, just remember that in investing, as in life, simplicity is a superpower. Simple wins. Take care. Hit the subscribe button if you want to be notified of our next podcast, and we look forward to talking again soon. Thank you all.
Thank you for listening to another episode of Different Makes a Difference. Just as every individual is unique, so are your financial circumstances. Be sure to talk to your professional advisors for advice related specifically to you. Our podcast is for general information purposes for Canadians only. The views expressed are those of the presenters and may not reflect the opinions of Odlum Brown. Be sure to check out our full disclaimer and subscribe to the podcast at odlumbrown.com/differentmakesadifference. Odlum Brown is a member of the Canadian Investor Protection Fund.